Hi everyone and welcome back to our brand new episode. My name is Marcus and I'll be your host. In today's episode we're going to take a look at Walmart. If you're new to this channel, what we do here is that we study and analyze stocks. We go through the fundamentals and the technical analysis of a stock, but we also talk about finance and investing. If you've been here before, thank you so much for coming back. I truly hope you guys will enjoy this episode, and please give me a thumbs up, comment, subscribe, and let me know what you think, but also what stocks you want me to take a look at. All right, thank you. Now let's get started. As I mentioned, we are going to take a look at Walmart, and Walmart is traded on the New York Stock Exchange, and it's in the trade and service sector. And their market capitalization is at $424 billion, and their revenue is at $566 billion. Their PE ratio is currently at 42. Guys, normally I like to take a look at companies with a PE ratio of 20 or below. Having 42 is above what I'm looking for, but it also tells you that the market expectation of the company is high, and the risk is if the company doesn't meet those expectation, we will see the price fall. So in my eyes, a PE ratio is too high, so that is a no for me. Profit margin is 1.7%, which is extremely low. I like to take a look at companies with a profit margin of 15% or higher, and having 1.7% in profit margin, it's a no for me. I don't like that at all. Price to sales ratio is 0.7. Normally, I like to take a look at companies with a price to sales ratio of maximum 2. Having 0.7 looks good to me. It's within my range, so I like that. Price to book value is currently at 5. Now, I like to take a look at companies with a price to book value of maximum 3. Having a price to book value of 5 is not far-fetched from the threshold, but still higher than I normally like to look at. So even though it's close, it's still a no. So if we summarize, the PE ratio is too high, price to sales ratio, I like that, and the price to book value is too high. So in my eyes, the company is overvalued. We need to see the stock price fall in order for it to become attractive in my eyes. Now, they pay out dividend of $2 per share. I like that. I love that income. And the effective return is 0.4%, which is low, which is very low. I would like to see a higher number. Price needs to fall so we can see a return, increase of return. So a dividend, I like that. Effective return, it's too low, so that is a no for me. Return on equity is 12%. Basically, what return on equity tells us investor is a company's ability to create a return on the invested equity. And as for investor, that is very important. 12% lower than most companies I've been looking at, but still a positive number. I like that, so that is a go. Return on asset at 7.8%. A bit low number, but still it's positive, so I like that. It's a go for me as well. And the stock is currently traded at $151 per share. And if we look at the 50-day moving average, we can see that we are trading above it, but also above the 200-day moving average. So what does it tell us? It tells us that it's a clear signal that we might see price move even higher. So now let's take a look at the chart just real quick, and we can see on the short term we are trading in a positive trend channel, and that we are reaching a resistance level here, so we need to be cautious. The 50-day moving average and the 200-day moving average all signals that we might see price move higher, but it's very important to be cautious here, because if we go back a bit, we can see strong resistance levels here, 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 here. So we might see price reach the resistance level and fall back again towards in the channel towards the support channel, and this is where I would buy the stock. Now let's move over to the income statement. And what we can tell about by the income statement is that the total revenue went from $485 billion in 2017 and went up to $559 billion in 2020. So, and it has been increasing steadily over the years. I like that. So that is a plus. Gross profit went from $124 billion up to $138 billion. Not a huge increase, but we can see that it has been growing steadily ever since. So I like that. And the net income went from $13.6 billion up to down to 13.5 if we look at it. But and we can see here we fell off. We have been falling and increased 1 year and then fell off. So a bit of fluctuation. Normally I don't like fluctuation because it's harder to determine the company's future. But the net income is still in a good range, so I like that. So that is a plus for me. Now let's move over to the balance sheet. And what we are interested in here is that looking at the current asset versus the current liabilities. And I don't like what I'm seeing right now. And because the current assets is lower than the current liabilities. Basically, if they convert the current assets to cash and try to pay off, they'll still be in debt. I don't like that. And if we look at the total liability, it almost doubles the current assets. So that is a minus. I'm not liking what I'm seeing right here. And if we look at the total liabilities, it went from $121 billion in 2017 up to $171 billion. So they need to start paying off that debt. I don't like this at all. Now let's move over to the cash flow. And the cash flow, what we are interested in is the operating cash flow minus a capex investment or capital expenditure. And we can see here that the operating cash flow has been increasing. Well, if we fell off, we've been falling off, and here we increased again. Sure, it's a stagnation. As in my eyes, this is a stagnation. But overall, if we look at the difference between the operating cash flow and the capital expenditure, we are still in a good. We have a huge leg room of $26 billion, and it has been improving ever since. So I like this one. Now let's move over to the key figures, and what we can see here that the earnings per share went from $4.4 per share in 2017 up to $4.7 per share. Not a huge increase. We fell off a few years, then we increased and it fell off. So fluctuation, I don't like fluctuation. As I mentioned, I like to have a clear forecast of the future. So earnings per share stagnation, still a positive thing, but it's not a strong positive. It's not that strong. Revenue per share went from $158 per share up to $197 per share, and it has been increasing ever since. That is strong. I like that. So it's a major positive thing. Equity per share went from $25 per share up to $28 per share, and it has been increasing. We fell off a year, stagnating, a fluctuation, still positive. I like that. Dividends went from $2 per share up to $2.3 per share and has been growing steadily. I like that. I like increase, dividend increase. So that's a positive thing. Now, dividend share went from 45% up to 48%. I like to look at companies that pays out less than let me see here, less than 60%. That is my threshold, because I want some of that capital to remain in the company, for the company to reinvest, become more efficient and increase their profit and just to perform better. So that's why I don't like companies that pay out too much of their profit. So below 60 it's a good, and there are below 61. Well, 1 year we went to 62.91, but overall 40%, 45. So that is a good thing. I like that. Plus, the profitability, gross margin went from 25.6% down to 24.8%, and it has been falling ever since. So I don't like that. The company needs to look at ways to reduce their cost of goods sold, become more efficient. So a minus. Their operating margin went from 4% down to 3.6%. As we see here, we fell quite a bit. We then increased, and then we have, well, a bit of stagnation or fluctuation. Well, still positive, but overall I would like to see them improve. Profit margin went from 2.8% down to 2.2%, and we fell off here, went up a bit, but overall it's still good, but it's just, I don't like the numbers. I don't like what I'm seeing right now. Normally, as I mentioned, I like 50% or higher. Having 2% is too low, but if we look at the development, we can see that it's still a lot of fluctuation. It's hard to determine the future, but overall I think they're performing well and they can do better in the future. So that's why I gave it a plus. So that's why. The return on equity, basically, as I mentioned, return on equity for investors is very important, and it tells us about the company's ability to create return on the invested equity. As you buy more share, they increase the equity, so you need to be able to see that the company will actually create a return on your investment. And they went from 17.5% up to 16.6%. We fell off a year, and then we went back up, and now, as we have seen overall in the company, a lot of fluctuation, but overall I like what I'm seeing here. That is a plus. Return on assets, a low number, just as the profit margin. Return on assets, a low number, 6.8% down to 5.3%, and we fell off 2 years, then we went back up again, and then still same fluctuation, but still positive thing. They're doing well. Solidity, what solidity is that it tells us about how much of the total asset is financed by the equity, but also about the company's financial strength for the short term. And here we can see that it went from 39% down to 32%, and it's been going down ever since. This is negative. They need to improve their financial strength for the short term. Now, balance sheet liquidity, same thing as solidity, but instead, it looks at the company's financial strength for the long term. And here we went from 1.3 up to 1.5. We increased, we fell off a year, and now getting back to higher numbers. I like this. So short term needs to improve, but also in the long term. Debt ratio went from 1.5 up to 2.2. What this tells us is that the company has 2 times more debt than equity in the company, and it has been growing steadily ever since. This is a minus. The company needs to reduce their debt. Now, we have gone through the income statement, the balance sheet, the cash flow, the key figures. Now to the most important part of the software. And this pillars summarizes and gives you a clear, holistic, easy to digest overview of the company's performance. As if we summarize, we can see here that the PE ratio is above 20. That is a minus. They pay out dividends. I like that. The dividend payout is less than 60%. I like that. The dividends has increased over the past 5 years. I like that. And the numbers of outstanding shares have decreased. I like that. Basically, what that tells you is that your share of the company is growing because of fewer and fewer outstanding shares. But we also need to take a look at it because a lot of company increase the number of shares in order to bring in capital. And a lot of investors look at the debt and say, okay, the debt is not growing, but the number of outstanding shares, it has been growing tremendously, and that's so you need to be aware of that. If they buy back the shares, that's a positive thing for you, but if they increase the shares, is a negative for you, because your share of the company is fewer and fewer, or less. Now, revenue increased over the past 5 years. I like that. Positive profit margin above 15%. Let me take a look at it. I need to take a look at this one because it's not above 15%, so I need to take a look at this. Profit decreased over the past 5 years. That is a minus. Current assets above current liabilities. That is a minus. Solidity decreased over the past 5 years. Minus. Balance sheet liquidity increased over the past 5 years. That is a positive thing. And debt equity ratio increased over the past 5 years. That is a minus. Now let's jump over to the technical analysis of the stock. So here we have Walmart. Let me just lay down the support levels here, support line here, and let me change that color to green, and let me lay down the resistance level here, something like that, and let me change the color to red. So what we can see here is that we are moving in a positive direction in a growing channel here, and that we are also seeing that we are having higher lows and higher highs, meaning that we are moving in a positive direction. There's a lot of buyers that are pushing the price up. But we also need to be very cautious here, because as you can tell, we are we are touching a huge resistance level here. So even though the 50-day and the 200-day moving average both signal that we might see price move even higher, we need to be very cautious, because even though if the price move even higher, we might see a breakout, right? We might see a breakout over here. The way I would trade it is that I would wait for the price to fall down a bit, and for the buyers to have an opportunity to go in and push the price even higher. Now, I would wait for the price to break above the new high that it made when it broke out. That to me is a clear signal that we might see price move even higher, and that's where I would enter the trade. Otherwise, I would be patiently waiting for a new position, a new way to enter the trade. And one scenario would be that the price moves up to resistance, the sellers jump in and push the price lower to a new support line, and then the buyers come back to push the price even higher towards the resistance level. And if we enter at that levels, we might see a 25 or 30% price move. So that to me is a good trade, and that's how I would trade the stock. Now the best scenarios would be if we saw price move even lower to this level, $130 per share. That would be a good position or a good price to buy the stock for even higher numbers. So that's how I would trade the stock. How would you trade the stock? Please let me know in the comments. And that's it for this episode, guys. I truly hope you guys enjoyed this one. If you like this, please give me a thumbs up, comment, subscribe. Let me know what you think, but also what stocks you want me to take a look at. Thank you so much for watching. Until next time, take care. Bye bye.